Hi, Shaun. Thank you very much for joining us today. How are things in Toronto?
Yeah, Jimmy, good start of summer and looking forward to a good summer ahead, but it's great to see you.
Likewise. So, Shaun, before we do a deep dive on your various assets, why don't we just start with a brief overview of Triple Flag? How many assets are there in their portfolio? How many are producing? And what's the breakdown between gold and silver?
Yeah, we just turned 8. Can you believe it, Jimmy? And there are now 234 assets in the portfolio, very diversified. And really, we've generated the highest ounce growth in the sector in that time since we started. And that's really coming from 32 assets principally. So a lot of growth that we've demonstrated and a lot more with a lot of optionality to come. And so gold and silver, we are very concentrated deliberately in those commodities. We're up just over 90%. So you can think of it about 75, 76% gold, around 20% silver, which with the recent run-up in pricing has obviously been pretty handy. And then the rest is a bit of copper and nickel.
And the other element I want to ask you about your portfolio is country risk. And this is something it's always present in the mining industry, but it seems like it's becoming even more so here in the past year. But maybe you can just speak to how you and your team look at country risk and try to minimize it.
Yeah, it's been very topical lately, as you note. And, for us, firstly, I've had the good fortune of working all around the world in a lot of different mining jurisdictions. When we think of country risk, we think about it quite specifically because you can have the devil of a time trying to permit a mine in parts of the United States or Canada, for example. So I think that the broader regime and the specifics on the social license are very important. But on a high level, we're around 80% concentrated in Australia, North and South America, and traditional mining jurisdictions. That's by design. We've really constructed the portfolio with country risk in mind. Our biggest concentration is Australia, with assets like North Parkes and Fosterville as headliners. And when we go outside of those more mainstream jurisdictions, it's with a very clear focus on the size of the check, the level of security and commercial structure, but primarily the underlying ore body as well as the quality of the assets and the social license of the operator. And so you'll see a very diversified portfolio from that point of view, and I think a very competitive risk profile.
So that's a good overview of Triple Flag and your portfolio. Now I want to dive deeper in on a couple of your primary assets. The first one is North Parkes. This is your largest asset. It's a large copper mine in Australia, represents approximately 25% of your NAV, and it's been a huge driver of growth for Triple Flag. Maybe you can just speak to what the operator Evolution has been doing to drive this growth.
Yeah, so I've had the good fortune of, I'm still a bit jet lagged actually. I got back on the weekend from visiting the site. And as you know, Evolution acquired the asset from CMOC late last year in December. They are well advanced on integration, and there should be an analyst site visit there in a couple of weeks, and they'll be releasing a study on the next big zone E22 towards the end of June. But you may recall, Jimmy, this is an asset we bought back in 2020. It's a copper mine, but we stream gold and silver. And it's a mine that's been operating for 30 years, which has a visible reserve mine life into the 2050s, but many decades beyond, most likely, with the resources and the grade and the more than 1,000 square kilometer land package that we're exposed to. And so those reserves are only on 26 square kilometers. We did highlight at the end of last year that they were now entering into some high-grade gold zones with some open pits, E31 North, and we've seen that come into book in the first quarter. That'll really affect ounces for us in 24 as well as 25. But you would have seen a quarter-on-quarter increase in gold from North Parkes by about 90%, and that is think of it as roughly a doubling of contribution from the asset compared to prior years. So yeah, just a beautiful asset that in the prior 20 years it generated about 1 million ounces of gold and has an incredible mineral endowments and likelihood of reserve replacements over time and expansion potential.
And this is one of the great benefits of being associated with a copper mine is, unlike a gold mine, which might have a mine life of 10 years, these large copper mines could be 50 or 75 years or more.
Yeah, that's right. And the guys on the ground talk about this going on for 100 years. It has multi-ore sources. So I mentioned some of the open pits. They were actually the first fully automated underground mine in the world. They have these cigar-like porphyries, and they were the first, I think, in Australia to successfully do block cave mining. So there's block caves, sub-level caves, as well as open pits. And so you got that beautiful multi-ore source and this cadence of bringing on new ore bodies over time.
And the second asset I want to ask about is Impala Bafokeng. There was a change of ownership in the mine last year. The new operator is implementing a number of optimization projects. Maybe you can just speak to these projects and how they might impact productivity going forward.
Yeah, so RBPlat was, an incredible operator with a great social license. Their primary owners, the Bafokeng, really, this was like their sovereign wealth fund. The asset suffered a bit during a protracted takeover with Northern. It was a battle between Northern and Implats, which really, I think, saw some of their ramp-up deferred. And so I think now that that's resolved with Impala, with their track record, they're one of the leading PGM producers in the world. This is some of the last of the shallow Merensky high-grade ore bodies in the Bushveld igneous complex, and has synergies and is well located for Impala. So my expectation is they are going to integrate the asset, get the cost structure in line, and then utilize this platform to really ramp up and maximize the value from that asset as part of their integrated portfolio. We're really, I think, very privileged to have this. This is a multi-decade asset as well. We also provide $100,000 a year scholarship programs to continue to enhance their privilege to operate. But, I think you would have seen other competitors do streaming transactions on PGM assets in the same region. Those assets are ramping. This is a really well-advanced, incredible infrastructure, and I'm really happy to have this as part of the portfolio with that operator.
So let's look at your pipeline of growth now in your current portfolio and your guidance for the year. You mentioned this, but it's 105 to 115,000 gold equivalent ounces or GEOs, but you're guiding toward 140,000 within 5 years, which is significantly higher than any of your comps. How exactly will you achieve this growth? And maybe you can also touch on capital deployment.
Yeah, it's, I think the important thing, this is a model that gives top-line exposure, as you know, Jimmy. And it also allows you to achieve a level of diversification and optionality, which you cannot really replicate in a producing portfolio and ETFs. And I think we've seen that over the last 7 or so years. So I've mentioned the growth already, that 20% CAGR. You would have seen, even though we're the youngest of the intermediates and senior streamers at this stage, we've deployed since 2017, our first full year, equivalent capital to sort of the intermediates, and nearly half of that about the two largest peers in the sector. But we've generated 2 to 4 times the amount of growth in actual ounces over this period of time. And so I think the track record piece is employment, as well as being a sensible steward of capital. You'll see we have the highest insider ownership in the space. I hold a lot of shares, as does my senior management team in this company. And that really does drive our focus on growth and value of per share metrics. And to your point, that means not only do you look at ounce growth, but how much money you're spending to generate that growth, and the risk associated with delivery. So you'll see that the proportion of value, even though we've got those 234 assets, you'll see an excess of 70% of the value or the NAV in the portfolio is associated with producing assets, many of which are ramping, like North Parks, like the Stelldrift mine at Bafokeng Implats or Impala Bafokeng mine. And so a lot of the growth is associated with that. And as you'd appreciate, the risk profile is different if you are projecting growth from brownfields or existing mines that are ramping up with know-how, capital, and a track record compared to mines that perhaps have to be permitted, certainly have to be funded, and then have to be constructed and ramped up. You won't see a lot of that in those. So as you talk about that growth projection and the delivery to date, I think it's an important feature that investors should appreciate and think of that along with our track record to date.
So far we've been speaking about the producing assets. I want to look at the development assets now, which are 41. Is there one or two assets in the portfolio that you are most excited for that could lead to a lot of optionality going forward?
There is. I want to preface this by saying, the way we've chosen to compete in this sector is really through these larger, high optionality producing assets. And I've covered a bit of that already. But you'll see we've got over 200 in that non-producer category that over different time horizons are likely, some subset are likely to generate future GEOs. And these are things that aren't currently modeled, I think, by investors or analysts. So a good example in the last quarter is we got a few thousand GEOs, from Kensington, which is a new royalty that has come into production for us with Coeur as operator. Nobody was focusing on that. And I think that's the power of those non-producing assets. But alongside the one I've just mentioned, a lot of these, we've got, for example, Hope Bay with Agnico doing extensive work on that asset. I think they have a study coming out in 2025 or so. They're the right operator for that asset. And, we have a royalty on there. And I really think that'll be in not too many years from now, a good GEO contributor with a great operator. Kone, we've seen the Lundin family come in for some significant investment there. Martino and the CCO taking over as CEO. They've just got their environmental permits and, they should be looking to get their construction permits fairly soon. And I think probably in that 26, 27 timeframe, you will likely see that asset be a contributor. You'll see on our website, if you look at the deck that we have, there's a large subset of others in that sort of time frame, that 5-year time frame, which we've highlighted there, plus several beyond. But then spare a thought to there's so many others there that could contribute without further investment, which I think is an important feature of this model.
Shaun, let's look at the deal pipeline right now. I want to get a sense of what's happening out there just in terms of the number of deals that are being shopped and the size of the deals. And if there's more of a focus on gold or silver, what are you seeing?
Yeah, so I think this is an interesting environment for us. I can say quite clearly that at this very minute, we've looked at over 800 opportunities in the last 8 years for the transactions we've done. I think for the first time in some time, we've started to see a return of the things that we prefer to invest in, which are large check producing assets with good land packages, good prospectivity, and good expansion potential. And we're active on several of those. We are also active on the usual array of sort of more tuck-ins, smaller, maybe tens of millions, some producing, some not. You'd appreciate that in a business like this, there's a lot of businesses that really struggle to raise capital. And I think the sector is not being well served through, debt and equity capital markets for single asset producers and project developers. So you have to be very thoughtful in your portfolio construction, how much of that you want. We are always looking at a number of those things, and we will occasionally invest in that as well as some longer dated stuff. But with over 200 in that category, that's not a priority. It's more the larger, chunkier assets, either acquisition financing, where we're working alongside the capital providers, or indeed, looking to help miners improve their balance sheets and their liquidity profiles, or for investment in their ore bodies.
And when you speak to large, chunkier assets, which will require a larger check, can you quantify that?
Yeah, our sweet spot when we set out to start, because remember, we weren't spun out or burst with any assets. I built the team, we built our pipeline deal by deal. But we said that we were going to be gold and silver focused primarily, no oil and gas or coal, maybe do a bit of base metals or battery or transition metals in the portfolio. And we would write checks in maybe 1 to 500 million as our preferred part of the histogram. So we've done bigger, other than the M&A deal we did with Mavericks last year, which was over 600 million. The North Parks stream was the largest this sector's seen in the last 8 years at 550 million. And I think, we've obviously done smaller as well. But when you look at the deal pipeline and our capacity to fund, we've got nearly 700 million of liquidity. We're close to, zero net debt. And we're generating on a trailing basis 50 plus million of free cash flow a quarter. So we have ample firepower. So I think the pipeline we see and our abilities are actually very closely aligned. And when you consider the two largest in this space have committed, since we've been going, around 4 billion of capital each, and only been able to deliver negligible to no growth, I think that shows that we're really in that sort of sweet spot at the size we're at, to be able to continue to grow significantly for some time to come.
You mentioned earlier that your focus is on gold and silver. So currently 75% of the portfolio is gold, 20% is silver. Would you like to increase the silver component? I'm quite happy with our concentration of silver as well as gold. I think the important thing is between the two of them that we continue to maintain our focus on precious. If you think about it this way, our first transaction was on Cerro Lindo, which was roughly 2 million ounces a year of silver. So our first year in 2017, we were concentrated on one asset with one commodity in silver. And you can see how we've been able to grow diversification, scale, and the portfolio as a whole. So my point being that deals come along when they come along. It's important to stick to your strategy, and I think we've demonstrated that. We've got plenty of scope to be able to continue to grow both gold and silver, as well as some base metals if we find good deals. We've seen a lot of consolidation in the mining sector and also the royalty sector here in the last couple of years. Do you expect this trend to continue?
It sort of struck me, Jimmy, I don't know if you saw the NVIDIA results recently. I think just after their quarterly results, within a period of a week, I think they increased their market cap by $350 billion. And in some ways, it highlights the challenge to the mining sector. It's just one of scale and relevance, right? I mean, if one player like that, within such a short period, can put on so much market cap, think what it takes in the mining sector as a collective to approximate that. So I think that's the strongest argument if you're competing for the generalist dollar, is you need relevance and scale. And so, yes, we should have consolidation. We've contributed to it last year, as I mentioned, with Mavericks. We are value focused. So if there are sensible deals either to acquire or be acquired, we're obviously always in the market for that. I do think social barriers and that are often a challenge in the sector, but we should continue to see that. I think just with a strict shareholder lens, there is just natural synergies and good opportunity to continue to grow these businesses over time. So I think there should be.
So you touched on your balance sheet earlier, and you also mentioned your liquidity, but I just want to expand on this. How will you allocate cash flow in the coming year? Will you be focused on buybacks, dividends, or acquisitions?
Yeah, so, again, I think an important feature for us is, in a sector which very often issues equity, dilutes its shareholder base in the process. We're shareholders. We have very high levels of insider ownership. Capital allocation is at the core of how we think about our portfolio and our portfolio management. So part of that starts with paying a dividend. We pay, a sector competitive dividend, which we've grown 5% year on year. That consumes a little over $40 million US a year of cash flow. I mentioned our trailing cash generation run rate of over 50 million, bearing in mind we're growing and commodity prices have been pretty strong of late. So easy to service the dividend, and plenty of firepower to continue to grow. Our highest and best use of our capital continues to be acquisitions in businesses on accretive assets. And, we've demonstrated that, I think, by now over the last 8 years. We're no longer just, the new kid on the block. We've been around for some time now. So I suspect, investors should expect to see more of the disciplined growth and capital allocation we demonstrated in building the company today.
Shaun, one of the unique features that separates Triple Flag from its competitors is the relationship with Elliot Investment Management. And for those who aren't familiar with Elliot, it's a large fund manager based in New York with over $50 billion in assets. But what are the benefits of having Elliot as a partner?
Yeah, it's look, as a private company, they, with their balance sheet, allowed us to compete out the gate with our chosen competitor set, really the big three. And we felt that was the more sophisticated, rational end of the sector, and that's really, I think, what we've experienced. At that time, there were about 29 billion AUM, and we're our sole capital provider. And after going public on the TSX 3 years ago now, we bought an extra 264 million US on, and that took them down outside of management ownership. It was just them as a private business providing capital, but that took them down to about 82%. Now, what we've seen since then, like with the Mavericks transaction, which was a low premium deal that benefited both shareholders with some synergies, that took them down to 62%. And then with the Newmont team doing the Newcrest transaction, they placed their blocks out there, and Elliot actually bought just over 5 million shares as part of that transaction. So that took them to 67. So they haven't sold a share. They've been very supportive. They're very, very value focused. I think actually they're about 65 billion AUM now and just been growing incredibly. And as non-resource investors, they like gold. They love this model. They've been very good investors to us. And I expect them to just be very rational, value focused and patient because they have no sunset on their capital, unlike a lot of resource funds that perhaps invest in 5 years and exit in 2 or 3.
And I know you can't speak for Elliot, but given that they have this large holding, they must be very bullish on gold.
I think it's well publicized that they're intrinsically mistrustful of central bank money printing. All our governments are running deficits like, it's all going to be something you can keep doing forever. And that's not great from a monetary policy. And just, gold has an important place, I think, as a store of value. And so that's been at the core, I think, of their desire to work with us to build the company we've built. They like the exposure, and I expect they'll continue to want some exposure in this environment.
And I want to get your thoughts on what you're hearing from investors. Gold is up over 12% on the year. Silver's up significantly more. And given the current economic backdrop that we find ourselves in, and also the positive returns that we're starting to see in gold and silver, are you getting a lot more inbound calls from investors, both institutional and retail?
I think the short answer is yes. Look, other than visiting North Parks last week, we were marketing in Australia. It's quite clear that on the one hand, as much as the Chinese and others have been investing heavily, central banks, retail in gold exposure, I think in the West, guys are underweight. And I think that really represents an opportunity. I think with the producers, it's only recently that we've seen some of the cost inflation for some level off. So the increase in prices hasn't necessarily translated into margin expansion. And so a number of the investors we've seen have been looking at the top line exposure, the diversification, and the growth that we have offered. And I think over and above, recognize that of the intermediates and seniors, we are one of only 3 that met guidance last year, but we're the only guys to increase guidance this year out of the top 6 in the space. So I think that track record of delivery and ongoing growth has appealed to a number of investors, particularly with the favorable commodity backdrop.
Shaun, as we wrap up, what can investors expect in terms of news flow from Triple Flag in the coming months?
I think we just put out record quarterly earnings again of just nearly 28,000 GEOs underpinning those in Q1. Our focus is on continuing to deliver into yet another year of record growth, our eighth year. So there's a big focus on that. We are active on a number of transactions. I'm hoping we'll be able to convert some of those, but we will be disciplined to the final second on each and every one of these things. But I just think in the public eye, the importance of just continuing to be a reliable custodian of shareholder capital, delivering those quarters, delivering growth, and focusing on delivering more sensible transactions. while maintaining a sensible balance sheet and continuing to grow a dividend is a large part of what we'll look to deliver for our shareholders in the months and years ahead.
Well, Shaun, that was a great overview and a great update on Triple Flag, and I want to thank you very much for making time for us today.
Jimmy, thank you. It's great chatting to you again.